Good afternoon, everyone. Can you hear me okay? Lots of computer problems today, so I just want to be sure you can see the screens and you can hear me. Great. So today we're going to talk about intrinsic value. So most of you know about intrinsic value, what it means, but there are some risks to it, and I wanted to show you this. Now, number one, intrinsic value is just how much something is in the money relative to the strike price. So we could take Apple. Apple is one of my favorite to do. So Apple right now is 185.95. I think you could see that in there. Hoping it's nice and clear for you. And I have to add one more thing. So give me a second in here. There, welcome free room, welcome chart patterns mastery room, and welcome everywhere else. So we're actually restreaming this. So what we're talking about today is intrinsic value. Extrinsic value is when you're out of the money. So let's take Apple and see how that works, and I'll show you on how this works. So the first things first is intrinsic value. So if Apple is 185, the intrinsic value of the 185s is only the price of the stock minus the strike. So the intrinsic value right now is 77 cents. So you're paying a lot of VIG. So you're basically buying a lot of air. So when I try to buy an option and I want to bet on direction, I usually buy something. If it's an Apple, I'll buy it more in the money. So, and I'll show you that. So the farther you get in the money, the less the premium is of the extrinsic. The extrinsic is the air. So that is the what's left for the time premium. So the easy way to do this is like this. If the stock is 185.90, so you know that the 185 is 215. So it's got a lot of premium. Just look at the put side. That will tell you how much premium you're paying over the intrinsic. So it's a quick way to do it. So let's say you go to the 180s. You're like, I want to buy the 180s. Well, there's only 17 cents a premium. Because what happens is if you buy the 185s and the stock slowly goes up, well, this put is going to get killed, which means the premium that is included in that will get hit. And you actually might lose money, even if you're right. So, like in John Carter's book, he goes over delta. So if he's really bullish or bearish, he'll usually do like a 70 delta. So like in here, 78, 89 in here. A delta is just the rate of change of the option. So if the stock goes up a point, theoretically, this goes up 89 cents. Theoretically. The difference, though, is the higher it goes, the higher the delta goes. And that's called gamma. But I don't want to really get into that. That gets sort of involved. I don't use it that much. But this is what you want to see. The rate of change of the delta. As you see, if you move this 2.5 points, the delta only goes up 4 cents. So because it's so far in the money already. But all you have to do is quickly look at the put side, and that will tell you how much premium you're paying. So I just want to make you clear in there. And that's the easy way I did it on the floor, and that's the way I do it now. So I just look at the put side, and that gives me a good idea of if I want to pay up. So if I'm really bullish, sure, I'll probably buy the in the money like back here. Now, the problem is that if the stock gets nailed, yeah, you're going to lose almost 1-for-1. So I wanted to show you a couple of things of how I'd play it. So I want to combine charts with this, but I just want you to know this is all about how much in the money relative to the strike price. So this is in the money by 8 fit. Well, you could just see it. I'll take the 80. The 80 is 582 in the money, but it's trading at 620. Yeah, that's your VIG. Where the puts are trading, that's the premium you're paying. Not a lot. The problem, like I said, though, is the delta is so high, it's like buying stock. It's just you're doing it a lot cheaper. So the key in here is which one do you do and when. So on the put side, by the way, same thing. The 190 put, how much is it in the money? So you just take the price minus 190 or 190 minus the price. I always screw that up. So it's 415. 415 in the money. So what happens? Yeah, that's the premium you're paying. Theoretically, you got to add in like interest and all that stuff. But theoretically, that's the way it works. Now, this is where it gets interesting, is when you see a chart pattern. So if you see a chart pattern that, let's say, this infamous Brecher ledge I talk about. So that's when a stock gets nailed and then forms like a horizontal bear flag. Not a normal bear flag, but a horizontal. Now, the reason that then I'll buy more air is because if it goes down fast and you're buying puts, then the options are going to go up faster because the delta goes up on you. So if this stock goes down slowly, yeah, you're going to lose on time premium. But if the stock goes down fast, you want the most bang for the buck. So if this stock is right where it is, and the stock today forms like a bear flag, so I think it's going down by that amount. Just for the day. I'm talking about for the day. I'm going to be buying the 187.5 puts because I'm looking for fastness. I'm looking for how fast it goes down. So the risk reward for me becomes higher because, yeah, I'm buying a lot of premium. But if I'm wrong, I'm just not going to lose that much. And if I'm right, it's going to go down fast enough. And that's why I'd rather play that one. So that's one way I play it. I just want you to realize that. Another thing about in the money or out of the money premium, the more in the money your option is, usually the wider the spreads. That's always problematic in there. But when it really comes down to it, let's say you're really bullish on Apple. Not today. Let's say over the week. You're really bullish on it. Then you'd probably buy the one six points in the money. Right here. Hardly any premium. Like I said, look at the puts. The thing is, though, in here, it's all about leverage. So if you buy 5 of these calls, it's $3,000. If you buy 500 shares of stock, it's a lot. So a lot more than that, that's for sure. It's going to be 185,000 divided by 2. So you're talking about $90,000, 92,500. If this goes up a point, yeah, you'll make a point on 500 shares. On the other hand, you're making $500 on a $92,000 investment. This is 1-to-1. If it goes up a point, you have a $3,000 investment, you make $500. Yeah, that percentage-wise, it's almost 20%. So that's why people buy deep in the money options. So just keep that in mind. Now, when it comes to things, there are other ways I like to play this. So I just want you to know that there are other ways I like to play this. But the thing is, and it gets confusing in here about extrinsic and intrinsic. I just think intrinsic means in the money. Don't get me wrong, I screw that up all the time. But intrinsic just means it's in the money. So the extrinsic is the air, the time premium. So the closer you go to the end of the week, let's say it's right here, the cheaper the puts out of the money get. So these lose their premium. So that's the way I look at it when it comes to that. Now, there's a big thing that I go to YouTube, I look at all this stuff. There's a big thing that a lot of people miss. Big thing. Let's go into not Apple. We're going to go into something that has a big old dividend like UNH. Has a dollar, I don't know if you can see that, $1.88 dividend right there. So the day of X date, the stock trades without the dividend. So that the stock gets reduced by the amount of the dividend. So this is where buying in the money calls is extremely dangerous. What's that mean? Well, let's say the stock's 480. I mean, right here, and it has $1.90, let's round off dividend. So I buy it the day before. I get the $1.90 dividend, but they make up for that by it being down $1.90 the next day. So buying the dividend, it's a wash. If you have it long term, fine. But the problem with that is if you buy the 470 call, the 470 call has hardly any premium. So what happens is the day of the dividend, the X date, this stock gets reduced by almost $1.90. So do the calls because they are so far in the money. So you lose the dividend. It goes down by the amount of the dividend, but you don't get the dividend. So if you have in the money options that far in the money with the dividend coming, you could definitely get hurt. So just keep that in mind. Now, I know a lot of people that do the opposite. When we were on the floor, what they do is they would short the stock. Let me get it right. Well, what they do is try to capture people not getting out. Usually the 470s, what people do is they exercise their option, they take the stock and get the dividend. The problem is it's expensive. So just keep that in mind. So a lot of people, what they did is they do the opposite. So they short the call and they'd short the stock. They know they're losing $1.80 here, but they're hoping that, buy the stock, and short the call. So this goes down by $1.80, but they get the dividend. But the call goes down $1.80. So guess what? This is a buy right. They're buying stock. They're selling the call. The stock goes down by $1.80, but they get the dividend. Then this goes down by $1.80 and they make a free $1.80. So just keep that in mind that professionals, that's what they're doing. So I usually, if I see a dividend coming, I am not going to buy that. Now, keep in mind that if you bought the one slightly in the money, they're not going to go down by $1.80 because their delta is less. Probably 54 cents, they go down by 90 cents. It's still not worth it to me. I wouldn't do it. So when I'm trading options that are in the money, I'm always cognizant of when the dividend is. So I try to avoid that. So just, keep that in mind when you're trading in the money options. It gets really, really, you don't want to get hooked. Let's just put it that way. The market makers are doing the opposite. They're trying to capture a dividend of somebody not exercising their stuff. So just keep that in mind. Another way, there's a number of ways to do it that get really complicated, but it was called on the floor skating, where somebody did not exercise their call. They lost the dividend, and the market makers are doing the opposite. They're hoping somebody forgets to tell their firm to exercise it. So just keep that in mind. Very interesting in there. Now, there are different ways to play in the money options. So my favorite way to play it is near the end of expiration, like in weeklies. So I like playing this. We're going to go to sound. I'm not in it anymore. I got a lot of people in down here. But the day before expiration, the stock was 3. So what do you want? You want the stock to go up the next day. So let's say the stock was 3. So let's say you want to buy 1,000 shares. What happens if they announce something terrible in an SEC investigation and it goes down to 1? You lose 2 points. Instead, what a lot of people do, including me, is I'll go buy the 2.5 calls. They're 50 cents out of the money for the puts. So the puts are almost nothing. So you're buying the options at parity, which they're 50 cents in the money, and you're buying them probably at 50 cents, maybe 52 cents. The beauty of that is if it does what it did last expiration, you can basically make 42 cents that day on a 50-cent investment. That's all you're doing. You're buying in the money options that expire within the next few days because it's a cheaper way to play an up move. Because if this goes up a point, the things you have will go up a point. It's a great leverage play. So a lot of times I look for bull or bear flags, and I look for things that are slightly in the money because the out of the money puts are going to be almost zero or vice versa. So that's a great way to try to play these things. So I'm seeing if there are any questions. So usually what I do on here is this. So like today, you got the SPX looks like dirt. It's down 9 points. Do you buy in the money options because you're bearish? Well, the problem is that the out of the money. So let's say you buy the 445 puts. There's $8. Look at the calls. Yeah, you're paying $3 in premium. That's terrible. Plus, if that rallies, you could lose $8. If I'm going to buy something in the money like that, I'm usually going to try to cover that premium. So I'll usually buy like the 43, 45, 43, 35. Now it's expensive at $5, but that way, if it sticks right here, guess what? You come out ahead. So you come out ahead when if you bought this instead, you'd lose $3. So that's the problem with playing the SPX. Everybody on the Chart Patterns Mastery knows that when I try to play the SPX, calls or puts, I like to do them as spreads even on expiration day because the out of the money options, whether you're buying the, let's say 43.30 calls are $11. They're $9 in the money. Yep, if it sits right here, you're going to lose that amount of premium. So that's why I almost always do them as spreads. So I just want you to know that. Can I give up a lot of money? Yeah, but that's the way I try to do it. Now, the other thing, if I see, let's say, a bull flag where I think this is going to 450, well, I'm not going to buy the 4,330 calls. I'll go and buy the slightly in the money. Let's say let's say this is, 330, 43.35s, but I'll probably do slightly in the money and then sell slightly out of the money if I'm bullish. If I'm real bullish, I do it wider. If I'm a little bullish, like this going to 43.45, I'll do it more narrow. So that way you lose less if you're wrong. I always care about losing less. Keep in mind that usually these things don't go crazy, like 50 points here and there. It did on Friday temporarily, but even today it was down like 16, and now it's nothing. It's down 10. In fact, I can show you something really cool. So we're going to go into this, and I'm going to take the SPX on a 1 minute chart on the left. So there's the SPX. This is great because it hasn't moved lately very much. On the right, I'm going to put the SPX 4330 calls. Now, let's take the 4335s. Now, keep in mind, now here we go. And this is where it gets interesting. So right here, if you bought them down here, 4334. So you picked the bottom and you bought, well, let's say 4335 right in here, and you bought the 4335 calls right here, right there when they were slightly in the money. They were 570. So just keep in mind that this has rallied now 5 to 6 points, and they're all of 670. So this has moved 5 points, and this has moved a point. Now, why is that true? Because the 4335 puts got annihilated. There. So when this went up, these puts went from $6 to 2.5. That amount of premium decay is what happens on the calls. So that's why you got to be very careful on expiration day. It's a lot better if you're bullish to buy the 4335 calls, let's say, and sell the 4345 calls. That way the 4345 calls are going to lose premium, and the ones you have in the money are going to go up, but you're paying for that buy with the premium you're selling. So I hope that makes sense, but I really hate paying a VIG. So I wish I could put it up here, but if you bought the 4335 calls, like I said, and you bought them, right now they've gone from right here, which is right here, about 6. So just figure 6 right here, maybe 620. So keep in mind, this is rallied now about 6 points. So these are going to go up, don't get me wrong, but you made 2.5 points. On the other hand, if you sold the 4345s against it, not only are you outlaying less money, but check out what just happened. Yeah, let's say it's market started going up. They were 273. Now they're 330. So the one side, you made like $3, and the other side, you lost all of 40 cents. So that time decay isn't as painful. That's all I mean. Are you limiting your profits? Yeah, you're limiting your profits. But on the other hand, you're sort of paying for your correct movement of the intrinsic by selling an extrinsic against it. So that's why a lot of times I do them as spreads. And I hope all this is making sense. But basically, like on our site, let's say you're playing, I'll show you a perfect example. Here's RCL. So we did fine on there because CCL came out with earnings that got destroyed. So it got destroyed. So RCL, our theory was it would get destroyed as well. So which ones do you buy? So the stock at the time was 97.32. That's where we shorted it. 97.32. You could buy the 98s, or you could buy like the hundreds. And let me show you what happened to the 98s. So we're going to go and show you this. So we shorted stock. Let's just make that clear. So on the right, I'm going to put the 98s. Now you were dead right on these. Don't Don't get me wrong. You were dead right. They don't trade that often, unfortunately. That's another thing. The farther in the money, the less liquid. Just keep that in mind. But the point is that if you hit the exact top, which we didn't back here, we shorted in here on the first rally. So 1040. At 1040, these were $2. $2. So this went down from where it is now. $1.30. $1.30. These you would have had to pay $2. Yep, they're 240. So the whole point is that when it goes down slowly, the out of the money put is going to get hit. And the in the money put, you're not going to make as much as you expect. So that's why I'd rather play real in the money. But in RCL, why did we trade stock? Because if you had bought the 98 puts, they had like a 30-cent wide market at the time. When the stock had a 5-cent market, I'd rather just play the stock. So that's how I try to play the intrinsic. Go and look at Broadcom, a monster. So Broadcom's 824. So let's say you wanted to buy the 810 puts, 810 calls. Look at the spread, 90 cents. That's rough. But the stock is also 90 cents. So guess what? You just don't play the stock, you don't play the stock or the options. It's just too wide. That's why you try to stick with like a Tesla, where the 235s, if you were that inclined to buy it, have a 15-cent wide market when the stock has a 5-cent wide. Not bad. Not bad. But if you want to play it that way, that's the way I'd play it. You play the active stocks and the in the monies that have tight markets. You got to have tight markets. So it's very difficult to get out. Let's just make that clear. Very difficult to get out if you're wrong. So that's why I watch those. Now you might say, how about Nvidia? That's a high flyer for you. Well, the stock has a 14-cent wide market, and the 395 calls have a 55-cent wide market. Not bad. The problem is if it goes up slowly, you're going to lose a lot of premium on these. If it has a tiny bull flag, sure, you could try to buy these. You could even buy those, but you got to be extremely careful about premium in here. So in the free room or in the social media room, do you have any questions for me? Let me tell you one thing when I was on the floor, though, if there are no questions. We played it with premium. So if I was bullish on Nvidia, I wouldn't even buy in the money calls. I'd sell out of the money puts because then I had the premium working for me. I mean, that's how we did it on the floor. Obviously, if it stops trading, opens down 20, you're screwed. So a lot of times what we do is you'd sell a real wide vertical credit spread. You can still do that now. Because right now you have $390 worth of risk. So you just go in here. If you're bearish, I didn't get this trade on the bottom. There you go. Trying to do a vertical on the bottom, putting my money where my mouth is, or the other way, mouth where my money is. But you go and do that. That way, the most you can lose is $20. Now, I know it looks like you're only collecting 2 and risking 20, but for your Schwab or Thinkorswim, the margin on that is just on how much you can lose minus the credit. So just want to show you on how I do things in here, what the intrinsic looks like, And the quickest way to do it is to look at the stock and quickly look at the puts. And that'll tell you how much premium you have. So hope you enjoyed that. And have a great day. And just go, like I said, you should experiment with it. Should go and do a paper trade with the ones that are, let's say, 1 point in the money, the 405s, and see what happens if this stock takes an hour and a half to go to 408, and see where those 405 calls are. It's a real interesting thing to watch. So thanks for being with me, and I will talk to you later.